Welcome to this presentation on convertible bonds. A convertible bond oblique debenture is a type of bond that could be converted into a specific number of shares of issuing company at a future date. Here we'll be covering the following aspects of convertible bonds: characteristics, valuation, and benefits of convertible bonds oblique debentures to the issuing company and investors. I am Aninda Datta, the presenter, and my contact details are mentioned. What is a convertible bond? Why companies issue convertible bonds? Components of convertible bond price, valuation of various kinds of optionally convertible bonds, graphical representation of various parts of convertible bonds value, conclusion of valuation of vanilla convertible bonds. A convertible debenture oblique bond is a hybrid instrument that combines the stability of a fixed income with potential for equity-like return. They start as regular bonds but give the bondholders the option to convert the bond into a specific number of shares after a specified date. Now, what are the various characteristics of convertible bonds? The conversion feature. The bondholder could convert the bonds into equity shares at a specified conversion price. Maturity date. The last date for conversion. Generally, convertible bonds have a maturity date by which the bonds are to be converted into shares of the issuing company or the face value is repaid. However, the features could be made flexible also. Conversion ratio. The conversion ratio determines how many shares the bondholder receives for each bond. Example, a conversion ratio of 10 means for each bond, the bondholder receives 10 shares. Lower fixed interest payments. Convertible bonds usually offer lower interest payments than those of the similar non-convertible bonds due to the embedded call option. Now, the higher the value of the call option, lower are the interest payouts. Now, these bonds are mostly unsecured and credit ratings are not needed always. Even though most convertible bonds are unsecured, but the equity conversion feature provides security. So most issues do not require a credit rating. The lifespan is around 4 to 5 years. As the conversion price is predetermined, so the maturity date is not very long, as the share price could move very significantly in the 4 to 5 years period. The convertible bonds are generally issued by companies with medium to low existing credit rating but high future growth potential. These bonds reduce the interest cost for issuers and defer the equity dilution. The reasons why companies choose convertible bonds. Low interest liability. Investors are willing to accept low interest due to embedded call option on the share. Deferment of equity dilution. The equity dilution is deferred till the share price rises at a future date. Tax advantage. The cost of debt is low due to tax deduction eligibility of the interest payment. Mortgaged assets not needed. As most convertibles are unsecured, so companies do not need mortgageable assets. Equity upside potential. Investors could participate in the equity upside. Downside protection. Equity downside is protected as bonds trade value is the floor price. Lower price volatility. Due to the presence of floor price of the convertible bonds, the price volatility of the convertible bonds is lower than the equity shares or the normal bonds. Downside protection from the rise in the market interest rate. The bond value does not fall below the equity conversion value on major fall in the market interest rate. So the duration risk on the lower side is much less compared to the normal bonds. Now, how does one arrive at the convertible bond price? There are three components of convertible bond price: straight bond value, conversion value, embedded option. The market value of every convertible bond is a different combination of these three components depending on the characteristics of the bond. Straight bond value. It is the value of the bond as if it were a non-convertible bond. It is calculated by discounting the bond's future coupon payments and face value back to the present day using a discount rate that reflects the bond's risk. Now this is the bond value formula usually used in calculating the present value of the bonds, where T is the time to maturity, R is the discount rate used for reflecting the yield to maturity of bonds of similar credit rating. Equity component, market value conversion, market linked conversion value. The conversion ratio is linked to stock price on conversion date. The key is estimating the stock price on conversion date. Now the conversion price is equal to P into price on conversion date. P is the percentage of the market price. Now conversion ratio equal to face value divided by the conversion price. Now the conversion value equal to conversion ratio into price on conversion. Stock price volatility. Since the stock price is market linked, the volatility plays a key role in valuing the conversion option if the conversion is on a future date. The conversion option is valued using Black-Scholes or binomial method. The volatility part is used while valuing the bond before the conversion date when the bondholder could exercise the conversion option, as the exact amount of likely conversion gain is not known. This volatility part also comes into play when the issuer enjoys a call option or the bondholder enjoys a put option on the bond. Now let's examine the valuation methodology of various kinds of optionally convertible bonds before the conversion date. The bondholder has to convert the face value into equity shares or the bond will be redeemed at face value. This is a condition. If this condition is satisfied, then it's called the vanilla convertible. Now let's examine the broad valuation methodology of vanilla convertibles. As the bondholder could always take the redemption in worst case scenario, so the straight value of the bond is the floor price. Since the bondholder has the option of converting to equity shares, so he can participate in the potential upside in price. The equity price is subject to market volatility and future market price is not known. So there is an embedded call option on the conversion ratio and the number of shares of every bonds with the predetermined conversion price as the strike price. There's the value of the bond equal to straight value plus the market value of the embedded call option. The call option value represents the potential excess of conversion value, market price on conversion date over the face value, as the entire face value is the strike price that needs to be paid to the issuers. If the first condition is not satisfied, then it's not a vanilla convertible, but the bondholder could continue to hold the bonds after conversion date and could convert to equity anytime before the redemption date. So before the conversion date, the valuation methodology is same as in the vanilla convertibles. But after the start of the conversion date, the market price of the share is known. So the call option value goes off from the bond value. The minimum bond value is maximum of straight value or the conversion value. The conversion value equal to conversion ratio into market price of the share. Now valuation of a convertible bonds varies as per the characteristics of the bonds. Now let's see the valuation of a vanilla convertible bonds during the pre-conversion period. Valuation of optionally convertible bonds before the conversion date has two components, straight bond value plus the conversion option. As the bondholders could redeem the bonds at face value if the equity conversion value is less than the bond's face value on the conversion day, so the straight value acts as a floor for the market price. However, if the equity price moves up, the bondholders have the option of converting it to equity shares. Bondholders could participate in equity upside. As the conversion date is in future, so the future market price of equity share is not known due to the price volatility. So the call option is added to the bond straight value to arrive at the approximate market price. The bonds as face value of 1,000 will mature after 2 years, coupon of 8%, interest payable half yearly, yield to maturity of 6%. The bondholder has the option of converting each bond to 10 equity shares after 2 years of maturity. So the conversion ratio is 10. The value of the call option is calculated by Black-Scholes. As the Black-Scholes is adapted as it gives a closed form solution. Now this gives the straight value calculation of the bonds. It's 1039. Now let's calculate using Black-Scholes the embedded call option value using the conversion ratio of 10. Now let's see how to combine the various price components to arrive at the total bond value before the start of the conversion period, where the conversion price is fixed. Now two cases have been considered. In the first case, the conversion price is fixed at 100 and it gives a conversion ratio of 10. In the second case, the conversion price is the 80% of the market price. Thus, this gray line shows the conversion at 100 and the green line shows the variable conversion. The two conversion curves intersect at 125. The market price of equity at both the C's are equal. The C value has been calculated using Black-Scholes, using this for the details given here, and conversion price is the strike price. Now let's see how the total conversion value, call option value, and the straight bond value move with the changes in the strike price. Sorry, changes in the stock price. The red line call option value increases with the increase in the stock price. The straight value of the bond remains fixed as the yield to maturity is fixed, and the total bond value also increases with the increase in the call option value, this gray line. Here the bond value is calculated at the conversion price of 100. Now let's see the bond value where the conversion price is variable, that is at a certain percentage of the stock price. Now let's see how the various components of the bond value move with the increase in the stock price. The straight value line is parallel to the x-axis as the yield to maturity is constant. The call option value increases at a consistent rate with the increase in the stock price. The bond value also increases due to increase in the call option price, call option value. As the conversion price is variable at 80% of spot price, so the call option value varies linearly with the spot price. The C value curve is a line with a constant slope. The upward slope of C value is much less than that of the fixed conversion price, so the bond value curve is also straightish compared to the previous graph. This kind of variable conversion price is suitable for issuers who expect a sharp rise in the share price. Thus, the biggest risk to investors in plain vanilla convertible bonds is that equity quoting at lower market price than the predetermined conversion price on conversion date, as they receive lower interest than normal bonds of the same maturity and the credit rating. After starting of the conversion period, the call option part is replaced by the conversion value as the market price of the share is known. Thus, the conversion value equal to conversion ratio into market price of the share. The minimum market price of the bond equal to maximum of the bond straight value into or the conversion value. If the bond price falls below this value, then that creates an arbitrage opportunity to buy the issuer share at less than the market price. These areas and other aspects of the convertible bond price would be covered in the next video. So this concludes this presentation. Thanks for watching.